for our conversation today. We're just having a few technical difficulties, but we'll be welcoming other Bank and Yourself professionals here shortly. But I didn't want to make anybody wait any longer, and also don't want to make the live algorithms mad at me or anything. So I thought I would jump in here. I'm super excited about today's conversation. We've got a little bit of an outline. You can see it also in the description, some of the questions we're going to ponder today. What I invite you to do is make yourself at home, grab, a cup of tea, some water, whatever is good for you, what you love, and make use of the chat. We want to hear from you as we're talking today. What is your feedback? What questions do you have? How can we make sure we're talking about what you want to hear about? The banking crisis and what's happening there is something a lot of people have questions about. There's a lot of different stories that have been out there in the mainstream media. And of course, the stories are continuing to develop. So we don't know, there's news every day, it feels like almost. So share with us, what do you want to dig into? What do you want to hear our perspectives on? Not being, mainstream media people, we're financial professionals. We've got our own unique take on it and those kind of things. And then, of course, also about the bank on yourself concept. What questions, thoughts, ideas do you want to bring into the conversation? This is meant to be all of us together, sharing, conversing, having a lot of fun. So, we're going to be welcoming Brandon and Mark here in a few minutes or few seconds. We'll see as soon as they're ready. They can let me know. And I also want to welcome you here for the conversation as well. So if you're hearing my voice, I want to see you in the comments, say hi, ask a question, jump in. And let's get Mark in here too. Let's
We
maybe
did
move
it.
things around a little bit. There we go. Settle in. We're going to have a lot of fun. We are live, obviously. So welcome, Mark. Welcome, Brandon. Thank God you're here.
Yeah, glad to be
Yeah,
here. Thank you.
I would say a lot has happened since we did our last live. We did it a couple months ago, actually, because life has been a little busy for all of us. We were trying to do it on the regular on the every end of last Friday of the month. However, the last Friday of the month has been a little hectic for all of us. While we had to go on a little hiatus, it seemed like the world went crazy and we had a lot to talk about that we just couldn't talk about because we were too busy trying to help people.
It's true. Yeah, there's it's sort of like the idea whose time has come, and nothing can stop one of those ideas as it's just coming down the mountain. And the, I think the intense pressure on the banking sector, we're going to be talking about that. The unbelievable cracks in the foundation of the economy, we're going to be talking about that. And most importantly, what you can do about it to not just protect yourself, but thrive in these circumstances to give you the very best financial future you can count on in the months and years ahead.
Yeah. But and I gotta say, I'm getting a lot of people who are worried. Maybe that's why our calendar is so booked up, and asking me this question. Hence, why we created this, or why we're doing this video. So, anyway, lots
Yeah,
of questions about this.
yeah. Can we start with some stories of when, take us back, or we'll take ourselves back to when the news was breaking about Silicon Valley Bank and that weekend. I don't remember the exact date. It was like late February, early March. And what that initial experience was like. I don't know about you two, but I wasn't surprised knowing the history of banking and how we've been here before and the cycles that repeat. I was like, yep, we knew this was coming. Do you guys have that same kind of feeling?
Yeah, I
know I did.
really didn't think I didn't think the collapse of a bank was going to have that much of a ripple effect. Mainly because maybe we cut our teeth in the 2008 crisis, and we were pretty used to, you and me, seeing banks just falling over like dead leaves at the end of fall. But this was not just a typical run of the mill mom and pop bank. This is apparently a fairly large bank. And what was so interesting was it was capped at the $250,000 Federal Deposit Insurance Corporation limit, like we're all familiar with, which coincidentally was raised in 2008 from 100,000 to 250. But anyway, the depositors were supposedly made whole as a result of this collapse of the Silicon Valley Bank, even beyond the $250,000 limit. So nobody lost a penny, and yet we're I guess supposedly told that it was not a taxpayer bailout. Now, where does the money come from? Well, the FDIC Insurance Corporation is where it comes from, and where does that money come from? Well, it comes from banks paying a premium into FDIC to be considered a member of FDIC insurance. They're having to pay a premium. So when banks are, gobbling up the FDIC coffers, what do typically insurance companies have to do if they have not enough money on reserve? They have to raise premiums, right?
Yeah.
If you're auto insured, if too many people are getting in auto accidents, or if there's a big flood in Florida or something, they're going to have to raise the premiums to refill those coffers to cover the potential loss of the next bank. So where do you think all of those premiums are coming from? Banks aren't just made of money. I know it looks like they are, but where are they going to get the money? Well, they're going to get it by lowering the interest on our savings accounts. We're raising the interest on our on our loans, our credit cards, our lines of credit. So who actually is paying for the Silicon Valley bailout? Anybody want to take a guess?
The banks sure aren't.
Good guess. Great. Yeah. Yep. So who does that leave, right?
Right.
The suckers holding the bag.
Yeah,
the Americans. So,
and I don't want to skip over that first weekend when the news came out on Friday that Silicon Valley Bank was closing, and yet we didn't find out until Monday, right, that the FDIC was stepping in and what they were going to be doing. I remember getting an email from our payroll service that was like, if you have payroll in transit right now, do not worry, right? Money's still moving. We didn't use Silicon Valley Bank. I don't think our payroll service does, but they were worried about their customers who had just run payroll on Friday for like maybe payroll was supposed to be deposited on Friday and they were like trying to get ahead of it. And that was a lot. That was stressful. I actually have a good person I know that works at a startup, and they bank at Silicon Valley Bank, and she was in charge of making sure payroll went through. And
wow.
she could not meet with me that weekend. She was like, I'm scrambling to figure this out. That takes a toll on us. Forget about money for a second. That impacts our stress levels, right? How we experience life to be in that. And I'd have another person, a banker at a different bank, works, for that bank, that was running fire drills all weekend. Like, what do we do? How is this going to impact us? And so those ripples were like starting right away, and they're still continuing today. So even if we don't pay for it with lower interest rates on our savings accounts or higher interest rates on our loans, we're paying for it with our stress levels and our emotions. And it's not just people that are directly involved, but all the ripple effects from there too. Anything y'all want to speak to on that side of things as well?
I mean, I think knowing the ripple effects emotionally, and also what we've thought was stable. And, I mean, literally when people come to us, they're like, is it FDIC? And what does that actually mean? And blah, blah, blah. And just knowing that people are a bit scared, rightly so, because they were told, well, if you do this, this will be safe. This will be good. And then as I was listening to the breakdown of some of this, this is something that I heard from, I think it was called Capital Isn't. Something that they said in there was somehow the bank started collapsing because intelligent investors or sophisticated investors, that's what they said, sophisticated investors learned about certain things and they started pulling out their funds. And what that tells me was sophisticated investors caused the banking crisis. So banks really want us to be stupid, because if we had not been sophisticated, you know what I'm saying? I'm like, this seems a little interesting, in that, and it's wanting us to kind of be unaware of what's really going on. And the more we become aware, it affects our mental health, emotional health, and other things.
Yeah, Amanda, I'd say too, you're right. I think the unknowing of what was going to happen and what will happen, I think brings a great deal of stress and anxiety. I hear it in people's stories. I was talking to a couple before the banking crisis of 2023. I was talking to a couple. They were relating back to a credit union that they had worked with for 20 plus years. So this is the exact opposite of a big systemically important bank. This is a small credit union. They had worked with this credit union for 20 plus years, almost 25 years, and they had never missed a payment. They'd always been great bankers there. They'd always had their savings accounts there. And then as they're moving across country, one time they overdrafted on their bank account, and it caused some sort of problem for them. And she said it was like moving heaven and earth to try to get the fees reversed and things fixed up. So after 25 years of having a great relationship with the bank, having all their accounts there, one little mistake as they're moving across the country, sure, I might overdraft if I'm not paying close attention while I'm moving across country, and the bank can't make that one, waive one fee, right? She said that banking should be like a relationship, back and forth, being able to forgive one another when necessary.
Right.
And when banks, even smallish banks, are faced with, being a friendly bank versus profits, too often they choose the latter. They choose taking a profit, pulling the rug out from under us. And this is not uncommon for us to see. I don't know. I'd love to hear you guys and your thoughts here, but it's not uncommon to see how banks are really taking advantage of people in these sort of
Yeah.
situations.
I think of a story of a really good friend of mine who's an immigrant and had a bank account at a large international bank right here in the US, that's based here in the US. And she just got a notice one day, we're closing your account. And like that was it. She had to figure out what to do. And what that was gonna look like for her. And that was scary, right? It's like they can do that.
Wow. Yeah. Yeah. Well, I think that goes to even, I don't know why that person had their account closed,
She couldn't
but
figure it out
it's a
either.
reminder. Yeah. Well, it's a reminder that if banks just wake up on the wrong side of the economy one day, they can decide to kick us out of it's their world. We're just living in it. If we, maybe we don't look like them, sound like them, believe what they believe, whatever.
Yeah.
If we don't have the right, credentials in our accounts, if we're not doing the right things, dancing to their tune, they are the ones with the umbrellas. When it starts to rain, they tend to want them back.
Yeah.
As Mark Twain says, a banker is a fellow who will lend you his umbrella when the sun shines, but wants it back as soon as it starts to rain. And so whether it's the loans that they're taking back from us or the account itself, our savings and checking and all that, it's a reminder once again that it's their world. We're just living in it.
Yeah. I think, again, as you guys are here, put comments in here if you have questions. I can't guarantee we know, because we are not the Federal Reserve, which manipulates things, maybe, or Jamie Dimon or any of those people. But we can give some of our opinions and what we see on the regular. So if you have questions or concerns or amens, put them in the comments, because we'd love to hear. The thing I just again go back to is, this is something that we thought was central to us. It's like important to us. Even we have a 5-year-old, and Amanda and I were like just thinking about, oh yeah, he has enough money. Do we put the money in the bank? Because that's what we're taught to do, right? Or the Mary Poppins thing, and Is there any other way? Is something I think about. Is there a better way? Is it better to put it under a mattress? Is more bank collapses coming? Where do you think this is all leading to? Because it's died down a little bit. I mean, again, that was 2 months ago, and we now it's old news. But where do you think this is leading, Mark or Amanda?
Well, I'd love to just mention that we are not out of the woods yet with regard to banks, and you guys might know this, but I was doing some research, and apparently FDIC only has 1.2% of all of our deposits on reserve, and they just spent it. So it's mostly empty now. So we're down to almost no reserve at the FDIC. Where did they spend it? They spent it on Silicon Valley and the other guys that just toppled over. So again, they're refueling the tank right now as we speak with premiums from the banks. But even before, they only had 1.2% of all of our $22 trillion in bank savings and deposits in this country. Does that make you feel safe to think that FDIC could only handle 1% of the bank's failure? Okay, so in the Great Depression, almost half the banks went bankrupt. And in 2008, almost 10% went bankrupt.
Yeah.
So if 2008 happened again this year, FDIC would not be around anymore. And that's a surprising fact for a lot of people to realize. I'll also mention this quickly that, if you count all the assets that banks hold to market, if you were to price all of their assets, not to book value, but to market value, which I'll explain what that is in a minute, half of all banks would be insolvent if you just looked at their assets according to market value. What is market value? It's the real value. Okay. So let's say you wanted to buy a brand new car. That would be called, a new purchase. So brand new MSRP, buy it from the dealer, whatever it is, 50 grand, let's say, for a brand new nice car.
Yeah.
That's the book value of that vehicle. So when you buy it off the lot, it's book value. It's brand spanking new. And then let's say I drive my car around for 2 or 3 years. Now I'm going to sell it to Amanda. Amanda, are you going to buy it from me for $50,000? Probably not, right? There's depreciation. It smells like French fries in there. Okay, guilty as charged. Now you've got a market value of maybe $25,000, let's say. So banks are allowed to run their businesses with assets at book valuations, okay? Even though they've got all these half-spent bonds and everything else, and real estate that's depreciating and more, they've got assets that are tied to book valuations so that they look better on paper, but their market values on all their assets are actually about much lower in value. And this, when you do all the math on this, roughly 2,000, meaning almost half of all banks, would be considered insolvent if we were to just value all their stuff according to what they could sell it for in the open market today. Now, to me, this says red light, pay attention. The bank is not the safest place to park our cash. And so this is sort of what we see. When I see the market as it is today, that's sort of what I see. I don't think about my bank as a safe place. I don't care if you've got a mega bank or a micro bank. Unfortunately, we've got, I think, poor methodologies for valuations.
Yeah.
And then at some point, Amanda, I'd love for you to share at some point about what is fractional reserve banking and how does that fit into this whole picture. But maybe you have other things to say.
Before we get there, I love what you just shared. I listened to the podcast episode on the Not Your Average Financial podcast that came out today. Heard a lot of that same things in there. I recommend everybody go listen to that. Even more awesome stuff if you liked what you're hearing there. And because we're on YouTube and we're live, I can actually share my screen and show people a little bit of what, how I would share what you just said in maybe a little bit different of a way. So I'm going to share. And then the big thing to know here, and you'll see this when we look at it. I was blown away when I first learned years ago that when you look at a bank's balance sheet, that there's the assets and the liabilities. The assets are the loans The liabilities are the savings and checking account. From the bank's perspective, your money there is a liability to them. Your loan is their asset. So keep that in mind as we go here, because that's a really big thing here. And Les is confirming that in the chat too. If you're catching that, I want you to know that that's there. So here's
before you go in that, I just want to say, I believe when we talk about boutique banks and big banks, I believe one of them that went under was like not a small bank.
Yeah, none of them were really. Yeah.
That they weren't small banks.
So here is the FDIC's website. And here's these numbers that Mark was just sharing about their deposit insurance fund. And their balance increased in Q4 of 2022. But here's that reserve ratio, 1.27, which was up 1 basis point. If you're not familiar with that kind of financial language, that means up 0.1%. That's not very big.
Amanda, do you mind scrolling up on my side?
There we go.
We're kind of covering up some of that stuff with our videos.
Here you go. So it's right there, FDIC's website. You can see.
So you're saying this is not tinfoil hat stuff?
Yeah,
is that what
exactly.
You're saying here,
It's
Amanda?
right from them. Their Q1 for 2023 report is going live on May 31st. So next week, it's going to be live on YouTube when they release it. I'll try to remember to put that link in the show notes in case you want to get reminded and see when they bring out their Q1 for 2023 report, because I will be interested to see how those numbers changed. But then, so they have a bunch of press releases too. I've found it very interesting. This press release that they did March 26th, where they are digging into what they did with Silicon Valley Bank and so forth. And they're sharing how on March 10th, how much assets and deposits they have. Remember, assets are the debts that were owed to Silicon Valley Bank, and then deposits are their liabilities. And they sold them at a discount of $16.5 billion. And so if we go back to those other numbers, right, they had $128 billion. They took on the liabilities, right, the deposits at Silicon Valley Bank without regard to the $250,000 FDIC insurance limit. And then they sold those deposits, those liabilities, to other banks, right? There's the list of them somewhere here or on a different press release. And they sold them at a discount. So they're like immediately, like the balance would have gone from, if I'm interpreting this correctly, the balance would have gone down immediately in their deposit insurance because they were, they were taking on those liabilities. But then they sold those liabilities to the other banks that would take them on. Now those deposits are at those banks, but they gave them a big discount to take on those liabilities of $16.5 billion of a discount, which is now they're going to, if we read this in more detail, it's going to a loss share transaction. They're going to, like Mark was sharing, do a premium increase from the other banks to make up for that $16.5 billion of a discount that they gave. So wanted to share that. I really look forward to the Q1 2023 report when it comes out, because I want to see, how did these numbers change? Is it still 1.27? Is it more? Is it less? Right? In terms of the percentage there and comparing that. Because I think that'll be really interesting to see, like, post all of that, what's happened. And then what does that set us up for Q2, Q3, Q4 of this year as well?
Well, you guys know, I mean, we're all fairly exposed and researched up and experts on something called insurance around here. And what does FDIC stand for? Oh, yeah, Federal Deposit Insurance Corporation. So it sounds like a private entity, corporation, right? There's insurance in the name. So we'll get to how we might reinterpret this idea of insurance here shortly. But I just want to mention that the FDIC is supposed to be an insurance solution to a problem. So, insurance typically covers a loss. What's the loss? Oh, yeah, bank failure. So go back about 100 years in 1933, and that's when the FDIC was founded in the middle of the Great Depression. And it happened, of course, after the problems. Usually the results of new interventions are typically after the problem has happened. But it's supposedly been there for the last 100 years to give you a feeling of safety when you bring your money to the bank. You know that even if that bank fools around with wrong loans and does risky bets with your deposit, that you can still be made whole through this thing called the FDIC. Okay, so my question is, how did banks exist for thousands and thousands of years before an FDIC? What would you do? Like if there was no FDIC, let's imagine a world for a minute, guys, where there's no FDIC and you do need banking in your life and let's not get into bank on yourself just yet. What would you do with your green stuff to keep it safe? And what would you investigate the bank's balance sheet a little better? Maybe would you possibly do a little review, or maybe there'd be a Yelp page for banks? There is no safety. I don't know of any. I didn't do any research when I opened up my checking account here in town. I just grabbed the nearest one that's got the bank branch close to us, and I'm off to the races. What do you guys think? What would you do if there was no FDIC? What would you do to choose your bank?
Go ahead, Brandon. I was talking a lot there for a minute.
I would probably ask Amanda, what would we do? No, I do think about sometimes checking interest rates. What's the interest rate on it? How much am I going to make? Which is like, oh, it's now 0.3 something percent or something like that for savings and access and all that. Usually it's for convenience, which is really interesting. Keep it in a sock. That's what Olivia says.
Love that, Olivia. That's a great answer.
Usually at this point, it's like, what is the biggest one? Which is what I'm thinking about a lot is these bigger banks are buying big other banks at a discount. Well, really, maybe as I look for a bank, can I use it in somewhere else in another state and be okay without being paid fees? Which sounds awesome. Maybe. That I have convenience and all of that. But I wonder if there's ulterior motives on their end. Or is it too big to fail because it gets too big? I don't know.
Yeah, I would definitely be checking the reserves of the bank to see how much do they keep, how much are they required to, and that's where we get into the whole fractional reserve banking, which has not always been allowed, right? But is now allowed. And when what happens to the dollar I put in the bank, and the bank can then lend out 90 cents of that dollar, if not more, depending on the size of the bank. And then the person that gets the 90 cents then goes deposit in a different bank, and that bank's able to lend out 90% of that, which is like 80 cents or whatever. And now that my dollar is already, just with two banks turned into a lot more. It's more than it ends up doubling if you take it all the way out to all the people changing hands and moving it around. And that's scary. And the reserve requirements do change over time. Have you ever heard of the Basel Accords? Do you know that one?
That's ringing a bell. Give me a bit more context. Tell
Yeah,
us more.
so after 2008, the people get together around the world and they adopt the Basel Accords, and especially because of what happened with Lehman Brothers in particular. And it's all about the reserves that banks have. There's tier 1 reserves, that's their safest assets, tier 2 reserves, and then what the Basel Accords did was say tier 3 reserves are now outlawed. You cannot have tier 3 reserves. That was a change after the Great Recession and when these accords came into effect. But what I found really interesting there was a big news article that probably everybody missed back in June of 2022 that the top 1,000 world banks, that their tier 1 capital hit $10 trillion for the first time ever. Huge amount of tier 1 capital. That might get us excited,
Wow.
right?
Yeah.
And the in the US, if you look at where is that tier 1 capital, about 25% of US banks keep their tier 1 capital in one very specific place: bank-owned life insurance. Yeah,
Well,
and that's the latest I found. The latest number I could find
wow.
was $182.2 billion as of September
Mhm.
2020 in bank-owned life insurance as part of that tier 1 capital.
That's incredible. But remind me, how much does FDIC
Right, I
have
know.
in their
Let me go
coffers?
back to that and get you the specific number.
That's just kind of
128.2?
cool. So the life insurance cash values exceed the FDIC insurance, and the banks are using it as their own form of like tier 1 safe money
Yeah.
capital. That's a connection I'd never made before.
And
So
the larger the
fascinating.
bank, according to the reports that I was finding, the larger the bank, the more of their tier 1 reserves are in bank-owned life insurance.
Wow. Yeah, no, it's true, and including Bank of America. There's a statistic that shows that as recently as just a year or two ago, when I was doing some research on this, Bank of America's cash value life insurance cash value is worth more than all of the real estate that Bank of America owns combined. So, given that fact, why don't we know about that? And is that not something that we are encouraged to explore and look into for ourselves as Americans? If it's good enough for mega banks, so much so that they've got more combined cash in their policies cash value than they have on reserve at the FDIC. The other bank insurance is bank-owned life insurance. So, guys, maybe for those would now be a good time to sort of explore what is Bank on Yourself, how does it fit in with the banking crisis, and maybe talk through the implications.
Let's do it.
There.
Yeah.
Yeah, let's go there.
All right, cool. So I think I'll do kind of the primer for folks who just maybe don't know what it is at all, and then I'll pass the ball to you guys. So life insurance is a weird thing to be talking about after we just got done talking about the banking crisis that we might be going through. Maybe it's the end of the book. Maybe it's the first page of this banking crisis. We don't know yet. No one knows. However, life insurance companies have made it through this recent crisis. I haven't seen any news articles on bankrupt life insurance companies. In fact, if there was ever going to be a bankrupt crisis for life insurance, don't you think it should have been right after a worldwide pandemic? Like right after the pandemic, and then we get into this financial mess that we're in right now in 2023. Seems like now would be the time to be hearing about life insurance companies going belly up, but I'm not hearing any. If there are, maybe there's one or two that I've not heard of, but it's certainly not showing up in the news, right? So what is life insurance and how does it fit in? Well, for a lot of people, it's news to hear that you can pour wealth into a contract. And that maybe sounds like buying a house. You can buy a house and pay your house off, and you've got wealth in your house. Well, you have a contract with that wealth, meaning you have the deed to the house, for example. You can do the same with insurance contracts. Not all, like I can't build wealth with my auto policy, let's say, or my fire insurance or my health insurance, let's say, but you can build wealth with life insurance contracts. And if it's a cash value life insurance policy, we love dividend paying whole life insurance as a as a contract to build wealth. You're able to not just have a death benefit, but you're able to have a living benefit as well. We call that the cash value. That cash value can be a source of liquid money that you can access for any reason, in good times or bad. So it's liquid and accessible. Usually there's some significant tax advantages to accessing that money too. It could even be tax-free if it's designed properly. Next, it grows on a guaranteed basis. That cash value grows every single year, even this year, and we'll be hitting another all-time record high with all of our policies this year. No matter what's going on in the markets, real estate, banking markets, bond market, stock market, it just grows. and just uninterrupted, right? Compound growth. And it's a linear, as Les would love to probably hear us say, it's non-volatile. There's no volatility there. It's a linear projected growth every single year for the rest of our life. And one last thing, we can use it like a bank. It's not an FDIC insured bank, thank God. And we can borrow against it and use it like a bank for anything we might need, any big purchases. I just got off the phone with someone before this live, and we were working on helping him buy another duplex with his policies cash because he didn't want to use his HELOC, which was going to charge him 10% on a home equity line of credit, 10% on a HELOC. And then, of course, with a HELOC, the bank would be in control. None of that's necessary. When you have a bank on your self-designed policy, you can borrow against the policy and go buy your duplex or your car or whatever, and the policy will continue to earn interest as if you had never touched the money, giving us two places for our money to work at the same time. So I'd love to kind of let you guys take the ball and just sort of unpack some of those, or how does that relate to the banking situation we find ourselves in?
So there's one big aha moment I've had over the last few months with the banking crisis when I learned about how the FDIC could raise their premiums basically, or like take an extra premium. It's like if I'm a banker, when I buy a life insurance contract, a whole life insurance contract that builds a cash value, can the life insurance company change my premiums? No, they can't, unless they ask my permission and I give it, right? And so, like, if I'm a banker looking at, do I buy more bank in yourself type whole life insurance that builds a cash value, or do I tell the FDIC that they should raise my premium so that there's more coverage there to back me up? I'm gonna choose the one that I have more control over. That's a unilateral contract that can't be changed on me, no matter what Congress or the commissioner of a government agency decides to do. That's pretty cool. I mean,
That is pretty
I
cool.
never thought of it until I saw, oh wait, the FDIC can just say we're going to charge you an extra premium.
Yeah, it's so true. Yeah, you think about it like what I love about that, Amanda, is you're thinking like a banker. And given that, I'll give a shout out to Sarah Ibrahim and his podcast, Thinking Like a Bank. But you've got that mindset to think, all right, well, how does the bank perceive what's going on right now? And if I'm seeing a world where banks are going to be under struggle and under duress, and I want to take up market share and be the best banker I can be, I need a lot of liquid access to cash as a bank, so I can maybe be doing what JP Morgan Chase did when they bought up big shares from some of these recently defunct banks. So how do they do that? Well, I don't know exactly, but I know that they had to have some cash available to make the purchase, at least in part. And I bet at some point somebody had to say, let's grab some of that cash out of our policies, our $100 billion in cash value in these different policies. I'm betting some of that was at Chase, and they made the decision to use that as part of the purchase for these assets that they gobbled up from these different banks.
So I was also thinking, like, it wasn't that long ago when we had a virus that went after a lot of us. And at the same time, the interest rates and the HELOCs and everything was really low. And there was this drive, right? People were like doing refinances left and right. And the interest rates were low back in the day, way back 2 years ago. And now you just told me a HELOC is at 10%. Is that what I heard?
Yeah.
This is like, this would have been unheard of 2 years ago, right? And now it's a regular occurrence, and people were doing the same things with their things, saying, hey, how do we still do the results, get the results we want, right? Because they were doing the game 2 years ago, right, with the HELOC. Now it's getting a little harder, right? It's getting more and more difficult, and the interest rates are higher, 10%. This seems a bit interesting and suspect to me, that maybe there is something happening and they're a little worried, and that's why the interest rates seem to be creeping up. Seems to not be creeping up slowly either. I don't know.
So we have this same gentleman was considering, should I get this next duplex rental property with my HELOC, or should I use my policy? What would you say to that, Amanda? What are the benefits, advantages? Les has some comments about HELOCs as
Yeah,
well.
I'm gonna
So
show
how
this.
would you answer?
Yeah.
Yeah.
So yes, totally callable. The bank gets in trouble. They can be like, we're closing your line of credit. You owe us the balance right now. If they don't do that, they can instead just say, we're going to lower your limit. So now you were going to pay for this next thing or do this improvement with it. Now you can't because that's gone. Lots of control there. A lot of HELOCs are interest only for the payment, but that's still a requirement. You miss that, you're going to get a pretty big fee. Compare that, right, with the policy lens from Bank and Yourself type whole life insurance policies, where you're an owner of the company. When we use mutual companies, so you can make loan repayments or not. Right, it's up to you. You can. We always recommend doing that. Whenever you take a loan, have a plan to pay it back, whether it's monthly or at the end of 3 years or, whatever it might be. Good to do that, but not required. And then one of the things I love is, as we've seen interest rates changing a lot just in the banking side of things with policy loans, they cannot change that quickly. It can't be like all of a sudden tomorrow you're going to go from 5% to 10%. And then also the way that it's calculated, it's simple interest rather than compound interest, right? There's all these amazing things, and the difference between the simple and compound can be really big. Be
Hmm.
trying to do apples to apples comparison, a compound interest versus a simple interest. The simple interest, if you're taking a loan, paying it back over 5 years, might be more. A 5% simple interest looks more like a 3% compounding interest. That's a pretty big difference. So then if you're going from 5 to 10% compound, that's a big jump. But even the simple interest can't do that. They can only adjust it by small increments. The increment can change depending on your state, those kind of things. So, but it's still really small.
Is this a time where I would be able to share
Oh,
my screen and
yes.
walk through what you just said in such? I mean, that was well said, and it bears repeating the importance of what you just
Go
said,
for it.
Amanda, and the capacity for. And if I share my screen, I hope I don't break something here. But what I think I'd like to make sure everyone realizes is this is available to us today. You can do this today. You can opt out of the banking misery that has happened / will happen / will always happen, because banks have done this for thousands of years. But one by one, family by family, each of us can choose to opt out with the vast majority of your wealth out of the banking system. Sure, I still have a checking account, whatever, but it's not where I keep anything that I could consider like real wealth. It's for convenience. We get to use banks for our convenience rather than let the banks use us for their convenience. So let me share my screen and walk through an example of how these work in practice and how you can be your own Federal Reserve, your personal reserve. Okay. So let's see if I share screen here. I think I can pull up the entire screen over here, and there we are. Okay. All right, let's buy a car. And you might need to move our videos at some point here for some of this, Amanda, because part of my presentation is going to cover that up, I think, a little bit. We shall see. So let's say that we want to buy a car. And guys, I got to tell you, this is going to be terrible art, but you're going to have to deal with it because that's as good as it gets for this guy. So that's our $50,000 vehicle. And what are some ways we can buy a car? Well, one option is we borrow from the bank. There's our friendly banker right there, and he lends us 50 grand. And what do we do next, Amanda? What happens 30 days after we get a loan?
Oh, we got to start paying it back. And they
That's
start
right.
charging the
Exactly.
interest.
Exactly. Yeah, they start throwing interest. We have to throw interest in their pocket. Who gets to retire off that money, you or the bank?
We'll leave that as a
Bank.
hypothetical.
Yeah, good question. It's not in our pocket anymore, that's for sure. So I don't like that option. What's the next option? Well, I can save in a savings account and feel great for about 50. I call this the sugar high of finance, because you climb up that mountain, you feel so high, you feel so great. And then when it comes time to buy that car, what do? We have to withdraw that money out. And now we're down, crashing down, the sugar crash. We feel that empty feeling in our savings account. And the sticker price on this vehicle might say 50,000, but we all know that the true cost of that car is whatever 50 grand would have earned for us had we not, bought that car and just left that money invest instead. So we keep breaking compound growth when we pay cash for things. This is why I'm not going to go along with Dave Ramsey's Pied Piper tune that paying cash is the answer. It's not. You're financing it from your future self. You're stealing it from your future self. I would rather pay interest to another banker than steal from my future self by paying cash for things. But I'd rather do neither of those things because there's a better way, right? We can use our policies. This is a picture of a life insurance policy. And I know my art skills are unparalleled here, but there are two piles of money. There's the cash value, which we've talked about today, and there's the death benefit. Let's say, for example, that our cash value is $50,000 and available to borrow, and we have $500,000 in death benefit at this time. Okay. Let me pull over for a minute. Anybody want to make a comment or question?
You're doing great, Mark. I love your drawing skills. They're better than mine.
Oh, well,
way better than mine.
Talk to my 7-year-old. 7-year-old could beat us, all of us, I guess, then. Now, when we want to borrow money, we can, withdraw it from our policy, but I'd much prefer to borrow against another asset and use my cash value as collateral. So this other asset is the life insurance general account. We'll call it the pool. And then, generally speaking, when you request a loan from the life insurance company, Brandon, how long does it take to get that money from the life insurance company and into your pocket so you can pay cash for the car? How long typically?
Oh, I'd say 5 to 10 business days at most.
Mm-hmm. All right. So pretty quick. We're not talking 15 seconds like your savings account. So again, you want to keep some money in quick cash. I like Olivia's comment. I hope that's a very big sock, Olivia. Keep all that money in that big sock that you have. But some of it should stay in the regular banks. But, again, within 5 to 10 business days, you've got liquid access to your policy. So very liquid. Next, what happens if I did this yesterday and died today? Well, my family would get the brand new car. Way to go, family. And my family would get the $500,000 minus the loan balance. So $450,000, basically. This means because that death benefit is there, and this is why we're using life insurance, okay? Because it's life insurance, there's no urgent requirement to repay some sort of loan off this policy. They know, the insurance company knows that we are good for it because we're all going to graduate someday. So we get to decide, because of that fact, we get to determine our own repayment schedule. We are in control over if and when we repay this loan to the policy that we control. All right. So next, you mentioned, by the way, where did that money go? Is it gone or is it still in there growing, Amanda?
Yeah, it's still in there growing. And one of the things I loved about your podcast episode today was the great reminder of the reserve that is that pool and how much the life insurance company has to keep available so that if I do want to take that loan, I don't have to worry about there's been a run on the life insurance company. Is that money going to be available? I think you said 114% is the typical reserve requirement. That means of the cash available, they have that everyone could be loaning from their policies. They have that and more. Can you speak to that? Am I remembering that correctly?
Well, that's exactly right. Yeah, great memory. And yeah, that literally means that life insurance companies are more than 10 times more reserved, more safe than your typical bank. So let that sink in. 10 times safer.
Can I ask this? So one of the things that I know this will come up is Dave Ramsey loves to say, well, that was your money. They're just doing this and blah, 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 and how evil those insurance companies are. because
Look at that. You just paid interest on your own money.
yeah, and I've heard that many times, and people saying, "Well, what's that?" And how is this different than the HELOC strategy and people using that? Because you just bought the house, right? You paid equity into the house. So what's the difference between
Yeah.
this and the HELOC strategy that people love to talk about and using the liquidity of your house or whatever kind of
Well,
liquidity?
let's walk through the rest of this, and you tell me, guys, how this beats or doesn't beat other options like paying cash or borrowing from your home equity line of credit and more. We do see that the asset is still there. The cash value is still growing uninterrupted as if you hadn't touched it because you didn't. You didn't get the money. The money didn't come from your policy. It's still there growing. The money came from the pool. And we have to admit that the pool is interested in being repaid with interest. They are a for-profit enterprise after all. And as you mentioned, Amanda, these days they're in the 5% simple interest range. So that's 5% simple interest. And Amanda, you correctly brought that up earlier and how important it is to be charged simple interest all year long and only compounded annually in arrears. So what does that actually mean in plain English? Well, let's say that you chose to repay this loan over 4 years. Your repayment plan was a 4-year plan. Your decision, right? You get to decide your repayment. If it took you 4 years to repay this loan, you'd pay approximately $3,800 of interest, which works out to 1.9% if you do the math there. 3,800 divided by 50 divided by 4 years is a 1.9% annual percentage rate. Is that a pretty good deal for borrowing money, getting a car loan? Amanda, what do you think?
Yeah. I mean, I've seen them lower, but I've also seen them way higher, right?
Yep.
7.5% might be about average, depending on your credit score and so forth.
Yep. I know you guys have told the story about how you saw a truly lower interest rate loan on a car. These days, I'm seeing car loans in that 6 to 8% range,
Yeah.
aren't you?
Yeah.
Would you agree?
Yeah.
Yeah. So this is fairly affordable money, but even so, Brandon, to your question, Dave Ramsey would be screaming if he was watching this right now, hitting his keyboard. They're paying interest on their own money. The car was what? How much was the sticker price? The sticker price says $50,000. But we paid $53,820. Why would we do that? Why would we pay interest on this money? Oh, wait a minute. Where did this interest go? Back to the pool. Who owns this pool? Anybody want to chime in on that? Who owns this pool?
Millions of Americans.
The policyholders, the people that are part of that company's,
including the
payment.
policyholder in this example.
Yeah. We own the pool since we're the mutually owned life insurance company. We own the company that we have a policy with, and therefore our interest plus all the other investment options and bonds mostly and real estate, all of it comes back as apportioned dividends to our policies. And the simple example here is not going to be precise. So everyone's returns are going to be a little different, the internal rate of return. But let's just say over the last 50 years, the examples I've seen show whole life insurance doing somewhere in the middle single digit range. So 4 to 6% over the last 50 years. These days might be a little less with lower interest rates, but it could also be a lot higher depending on how long interest rates stay high. But for simple conversation, let's just say that you're getting 5% on this policy money. Again, that's 50 grand, earning 5% over how many years? 4 years, right? That's about $12,100 in gains. So just to kind of summarize this whole example, and I'll be done because I see our time, we earned 12 grand in our policy. We spent $3,800 to borrow the money out to buy the car. This means our arbitrage, we earned more than we spent, $8,300. Now, if we had just paid cash for that car, here's how much we would have. So, yeah, which of those two numbers would you guys rather have?
Exactly.
Yep.
Mic drop.
Yeah. So anyway, so why does this fit into our banking crisis, and what does this have to do with the banking situation that we find ourselves in? I guess what I'm wondering as I wrap my little thing up there is, what if just 10% of Americans did that? What if that's the way they did their banking? I'm not talking about totally removing ourselves from society, going like total raw vegan up in a mountain somewhere. I'm saying, if you could just bank on yourself, if just 1 in 10 of us did, what would that do to the problems that we see in the banking world today? What would that do to the Federal Reserve itself? What would it do to FDIC? What do you guys think? What implications? What are your takeaways from what we've been talking about together today?
Yeah, I love what Olivia put over on Facebook in response to your question. They're safer and happier.
That's
Yeah,
great.
thank you,
Yeah.
Olivia, for
And
commenting that. Brandon, were you going to say that?
oh, I was just going to say what it would do is just build us to being again healthier people and being in a place of sanity. And I think that that's the hard part is in the banking world is they profit off of insanity, off of craziness. And what we have to do is kind of as our both of our podcast is thinking smart about our money, thinking about how to be good stewards and maybe, I don't know, wondering how do we avoid some of this craziness and understand it. That's just me. But.
Yeah, and I would, if there's any economist, researcher type people out there, I want you to look into this more, because I want somebody to go back and look at America when half or more of Americans did have whole life insurance and they were using it to pay off their mortgages early or pay for their kids' weddings or buy cars or, all the things that you can use the cash value for. And that was, just 70 years ago or, 100 years. Like, it's been in the 20th century that was true. And if I look back at that time, not having lived during that time, right? I'm a kid of the 80s, right? I don't remember that time. But when I look back at that time, I'm not seeing the same worry and crisis in you know in such repeat, right? There's still world wars, there's still the Great Depression during that time, and yet that Great Depression could have been a whole lot worse, pun intended, if there hadn't been whole life insurance and so many Americans using it then. And there we
Mhm.
can look back and there's no reports of anybody with cash value and life insurance losing money during that time. Their cash value still stayed where it was, still continued growing. In fact, we work with companies that were there during that time and they still paid dividends during that time. Like, can you wow,
Mind
right?
blowing.
Like,
Yeah.
let's do the analysis. Let's actually dig into that. I want, the people at, major, PhD programs or with economists that are creating formulas and trying to predict what the market's going to do over the next 30 years. Let's look back and see what real Americans are experiencing then compared to now, and let's see what's changed. And that's probably going to be one of the biggest things that have changed.
But and
Mhm.
looking back at that and saying, how did this banking thing that's changed over the past, I don't know, 80 years, 40 years, whatever, how has that impacted our health? Again, going back to our initial thing and saying, do we want something different? And if we want something different, what is it? What do they say? The definition of insanity is doing the same thing and expecting different results. Do we want something different? Do we want a stable foundation in our finances? Being able to use our money in a smart way, as Elon Musk did that whole Twitter thing, right? Maybe I'm not saying he's smart in any of that, but I'm saying like using our equity and our policies to do cool things, not just buy a car, but maybe change the world in a positive way. Um, and maybe that's what we need is more people saying, I'm done with this. I want to build a good foundation for myself and change the ripple effect in not just the policies, but in other areas in business and real estate, and take control of that. That's for me. I'm sick of it. I'm tired of seeing banks, and I know it. We're not done with this conversation, but
Why don't you wrap us up,
Thank-
Mark? We got to go now.
No, I think I'll give final word over to the host here, or hostess, Amanda. Go
Okay.
for
Well,
it.
thank you for being here, sharing your wisdom with us, Mark, Brandon, and the people in the chat. The chat's not closed. You can still comment there. If you've got feedback, questions, we would love to still hear them. And if you have topics you want us to talk about in our next lives, please let us know. We would love to talk about them. And we've already changed one financial future. Olivia's planning to make her next car purchase, and is already thinking about how she can use some of the strategies we talked about today. So thanks for that, Olivia, and we'll see you all next time.
All right. Thanks for watching. Don't forget, subscribe and like and share.